obviously there's going to be multiple players within the industry. I know a slogan of yours or Lightbox is that we do self-storage differently. So can you talk about that a bit? What is it that differentiates you? And I'm sure that was a big reason you were able to score that big partnership with New York Life.
Yeah, Sly, in entering the business back 8 or 9 years or so ago, it was our goal to see if we could identify an investment thesis that we did not think was prevalent in the marketplace, that no one else was doing. And if you think about self-storage as a developer, most of the developers are individuals that reside within a certain MSA. Let's say Jacksonville, Florida. Let's say Omaha, Nebraska. These are two perfect real-time examples where a developer deploys some assets, they lease up, he deploys some more, they lease up, deploys some more, and so it becomes a regional play. Very few developers in the self-storage arena develop nationally. Well, us as a retail developer, right, we went with Target and Walmart and the various retailers went all over the United States. So it put a lot of pressure on us to make sure we knew our markets and we understood the psychographic nature of the demographics that were justifying maybe we develop a retail shopping center there. Same analysis in self-storage. However, I do think our differentiated nature of how we go about building our investment thesis, without a doubt, the thing that I think proves it out more and something that we are humbly most excited about and feels like it really gives and lends credibility to our investment thesis is New York Life. They went out with a request for what we call an RFP. A lot of folks would say it's a beauty pageant with 17 different self-storage platforms all across the United States. And little old Lightbox Storage Partners ends up winning the day. And the reason was because we do it differently. And I'll unpack that later for you. But New York Life found that our process, our approach, the granularity and the depth of which we go through due diligence was something that they were not seeing from the other operators. The big win for us, though, is that the New York Life approval it wasn't just a one stop. We ended up getting approved by their big board to invest money on behalf of their general account, to invest money on behalf of their Odyssey fund, as I mentioned earlier, to invest on behalf of their Scandinavian separate account. And now we've gotten approved by their Israeli separate account. So we're thrilled to death. New York Life is, without a doubt, in my humble opinion, a top 3 pedigreed investment platform. And I think what's unique to Lightbox Storage Partners is we are principal to principal with New York Life, right? This is not something where we're working through an opportunity fund or an intermediary, I would say. We are principal to principal with them. For our retail customers, though, for RJ's clients, what's really the significance of the New York Life relationship? You hope it says something about birds of a feather flock together, and there's some credibility that comes with it. But really, I think, if you would, allow me to tell you about these 3 buckets, which I think are elements that really benefit an RJ Kelly client in a manner that's kind of rare air in this sector. So the first is, the way we negotiate our relationship with New York Life, we're going to be able to bring in retail customers, RJ Kelly clients, on an equal basis with New York Life. So instead of being subordinate or instead of being behind, if you will, to the New York Life equity, we are shoulder to shoulder with New York Life. So we think that's very rare air in the space. You typically don't see that. New York Life will most likely invest between 90% to 51% of all the equity needed in most of our investment opportunities. So with that, they have the most skin in the game and the most to lose, right? So I think that lends itself to the second bucket, which is the intensity of their due diligence. You know, we have never worked with a group with the resource level that New York Life has. We've done a lot of business with institutional partners, but New York Life has, it appears, a professional for almost every element in the value chain, whether it be environmental contamination to structural steel to you name it. So I feel like we have benefits there that are intangible in nature, but by virtue of doing business with an 800-pound gorilla, you're getting the benefit, right, of all their capability that indirectly inures to the benefit of your customers. The last piece is, I don't know if it's as meaningful, but I think it's got a chance to be really economically impactful, and that's operating cost efficiencies. But really the best way I can describe this is through an example. Our first transaction that we closed with New York Life, we went to the market to secure property insurance. And I think as everybody on this call, especially folks in California, as well as possibly those in Florida, will recognize, right, that interest rates have been really challenging, but boy, property insurance has been right there behind it. And so we went out, this asset was in Charlottesville, Virginia, not on the beach or anything like that, but we went to our carrier, which was Chubb, best-in-class player, and got quoted the property insurance we needed for this investment. It was $36,000, all right, about where we'd expect. New York Life went out to their carrier. They were at $9,000. So you see, right, a demonstrable 25% of what we're used to paying by virtue of being aligned with New York Life. Now, the part about show me the math, and we don't want on this type of presentation to get overly granular, but our goal here was to really try to share with everyone on this that's watching the presentation to understand the impact of doing a deal in the traditional methodology of Lightbox Storage Partners, which is still great looking returns, which is still, I feel like, best in breed type returns, 20% or so above IRRs. But if you look at the impact of bringing in New York Life to be effectively 90% of the equity, we are 10% of the equity. We're effectively leveraging our equity 9 times, if you will, that our IRRs really go exponentially to the good. If you think about that, the rarity of that situation, you've got IRRs that are effectively doubling, but you got to ask yourself, am I absorbing risk for that? And it's exactly the opposite, right? You not only your returns are doubling, but I humbly believe your risk is lowering. Right? New York Life has lower leverage. New York Life has greater due diligence capability. New York Life has tremendous expertise. You look at it from the relationship of risk reward, or what a lot of people refer to kind of standard deviation. The risk reward with New York Life is really, really attractive. Returns are way, way up. Risk seems, in my opinion, to be way, way down. Now, there's a second institutional partner that's long-term in nature. I think it's incredibly rare to be with an institutional partner for 16 years and doing business with them on an equity or a debt basis, and that partner is Protective Life Insurance Corporation. They're also very large in size, $130 billion or so institution. They've been around also more than 100 years. They were 113 or so years, I believe, when Teddy Roosevelt was president. So it's certainly not a newcomer. They've got about $14 billion of committed assets under management in the real estate sector. And what's our relationship with Protective Life like? Well, over 16 years of doing a tremendous amount of activity with them, both in retail and self-storage, it gives us access to all types of debt capital. And the way that I would describe it with these 3 buckets, if you will, is the first is the long-term relationship. So with that, trust, faith, confidence in each other has proven itself out. We would not be in business on so many transactions over a 16-year period, right, if we couldn't generate recurring performance outcomes that they wanted. But the second, if you will, is that access to unique loans. And so with Protective Life, we have participating mortgage relationships with them that are very unique and allow us to borrow capital from Protective Life that is incredibly inexpensive. I'll tell you more there in just a second. And the last piece is, again, these institutional investors allow you to be more cost efficient. So with such, when you've done as much transactional activity as I have with Protective Life, we spend de minimis amount of outlay for legal fees. We spend a de minimis amount of outlay on trying to get the loan closed. Let me try to give you a data point, maybe more succinctly. And in our typical close, we're paying about $25,000 in legal. The industry pays typically about $100,000. We get our third-party reports and things of that nature. I think is about 50% of what the market pays. But again, like New York Life, right? Really, what's my mathematical benefit, Bill? Thank you. I appreciate that you have done a lot of work with these institutional partners, but how does it inure to me? How, if I'm an RJ Kelly client, how does this benefit me? And indirectly, you can see under our traditional methodology, again, opportunistic returns, good looking profile. But the way that Protective Life comes in, we get that same opportunity for equity return enhancement. And so you take New York Life together with Protective Life, and we get 2 levers, if you will, that allow us to generate, hopefully, superior returns. Forgive the hokiness of this slide, but this is really the essence to try to roll it all together. These are levers, or attempting to be levers. And the idea is that when we do a transaction, or we want to close on an acquisition, or we want to close on a development, we have different levers that we can play with that put us in a position to where we can generate different return profiles, thereby putting ourselves in a better position to generate superior returns for you as a customer, with more capital access, with more unique capital structures, with institutional partners that we think are going to increase our reward and decrease our risk.
Yeah, I mean, this is impressive, Bill, to have firms that have been in business for over 100 years each and to be partners with them. I think it's impressive if you had just one of the partnerships, let alone both.